Have you ever drawn a perfect trend line, entered your trade with full confidence, and just a few minutes later, boom, price drops, hits your stop loss, then reverses and flies exactly where you predicted? You sit there thinking, how did they know? Well, it's not magic. It's liquidity manipulation, one of the smartest tricks used by institutional traders to trap retail traders like you and me. Welcome back to LutaMarkets, where we break down how the market truly moves, not just what the textbooks say. Here, we don't follow retail myths. We trade based on institutional logic, liquidity flow, and smart money behavior. So, if you're tired of being trapped by fake breakouts and trendline tricks, make sure you subscribe and turn on the notification bell, because I'm about to show you exactly why your trend lines keep betraying you. Let's be real for a second. Most traders lose not because their analysis is terrible, but because they don't understand how liquidity works behind price movement. They draw their beautiful trend lines, find perfect support and resistance levels, and think, this time it's going to work. But what happens? The market fakes a move, wipes them out, and then takes off in the direction they expected. In this video, I'm going to explain why that happens, how institutions set up these traps, and what you can do instead, so that next time you trade with the big players, not against them. Look at this chart. You can see price making higher lows, points 1, 2, and 3, forming a clean ascending trend line. Everything looks great. The trend line is respected, structure is strong, and momentum looks bullish. Now, at point 4, traders see another perfect touch on the trend line. This is where most people start buying. They think, okay, it's respecting the trend line, I'm going long. But here's the problem. This is exactly what the institutions want you to do. Just when you enter your trade, price suddenly breaks below the trend line. Your stop loss gets hit, you feel frustrated, you think your analysis failed. But then, a few candles later, price shoots right back up and goes exactly where you predicted. Sound familiar? That's the liquidity trap, and it happens every single day in every major market. You have to understand something powerful. Big institutions, the banks, hedge funds, smart money, need liquidity to enter their trades. They can't just buy instantly like small traders. Their positions are massive. So what do? They look for areas where retail traders are placing stop losses, and one of the best places for that is below a clean trend line. Because guess what? Every retail trader sees the same trend line and places their stop just below it. That creates a pool of liquidity, a cluster of pending orders that institutions can use to fill their own buy positions. So before pushing price up, they intentionally break the trend line, just enough to grab those stop orders, collect liquidity, and then move the market in the true direction. It's not manipulation for fun, it's how liquidity fuels movement. Now that you understand this, the solution is simple. Don't trade directly off the trend line. Instead, look for institutional order blocks or demand zones below the trend line. Here's the logic. If price breaks below your trend line and forms a strong bullish reaction at a specific zone, that's likely the true institutional entry. That's where the banks are buying. So instead of buying at the trend line, wait for price to sweep liquidity first, then enter after confirmation from that institutional zone. This small shift in mindset from retail trendline trading to liquidity-based trading will completely change your results. Remember, we don't trade the line, we trade the zone behind it. If this video opened your eyes to how liquidity really works, I want you to comment below, "No more liquidity traps." Hit that like button to support this type of deep market content, and make sure you subscribe if you want to master the smart money concepts with me. And don't stop here. In the next video, I'll show you exactly how to identify and trade institutional order blocks, step by step. Trust me, once you understand this, you'll never look at charts the same way again.